We have with us Nilesh Shetty, Associate Fund Manager at Quantum Asset Management, joining us on the show live. Nilesh, good to have you. While there is, of course, a bit of tension on how things will shape up as far as the currency is concerned, how are you placing yourself in this market? What is the kind of portfolio strategy that you're adopting?
We are primarily bottom-up investors, so we really cannot take a view on currency. We have very limited capability of taking a view on currency. Fortunately, we have some allocation to technology companies, which we tend to hedge us given the sharp depreciation of rupee. But our internal sense of the rupee, wherein the debt team, which tracks or gives us our macro variables, the sense is the rupee, the scenario around rupee is not as bad as the current levels are. I think if you have a bit more clarity on GAR and taxation, the Vodafone taxation case, you might see a bit of improvement in the rupee and you might see a bit of resumption in flows. But till the lack of clarity is what is causing a bit of a problem in terms of flows within it, or near-term flows for India. And once you have that, you will have an improvement in the level of rupee. But within portfolio strategy, we primarily tend to take a view on the stocks per se and not on the rupee or any GDP macro variables.
Okay, just a note, the Delhi High Court has of course adjourned the IGL plea. So just a note of this hearing happening at a later point of time. You mentioned being bottoms up, Nilesh. Good afternoon, Neeraj here. What are you seeing with the auto pack? Because there is lots that's happening individually as well with the kind of numbers and the guidance that Hero came out with, or some of the dispatch numbers that have come out, or for that matter, what's happening with Tata Motors and the whole American demand scene as well. How are you viewing the auto pack and individually some of the companies and the way they are conducting their business now?
We remain fairly bullish on the auto sector per se. Again, the broad call remains the penetration in India is fairly low compared to even emerging economies, and you will have a catch up with India to the rest of the world. And within that, the space to play remains the sector leaders, and the environment around an auto company, be it after sales service and spare part availability and deeper or showrooms within or retail outlets within the interiors of the country, it's not that easy to replicate. You have companies competing with sector leaders for decades in India and still not being able to do major damage to sector leaders. So we remain very bullish on the story. Valuations are not as cheap as they were in say December, before the interest rate cycle or view around interest rate cycle changed. They are not expensive, but they are not cheap, and they are somewhere in between right now. So we remain very neutral at current levels, but I think at lower levels we would be happy to add these companies to our portfolio.
You know, the energy space essentially, especially the private oil companies, oil and gas companies there, what is the approach with these stocks right now? Because even in a market where we have seen some sectors like autos outperform, we haven't really seen too much movement in the energy stocks. Does that offer cushion in a portfolio?
No, we tend to primarily move at a fairly limited valuation band, where if we get these companies at a fairly large discount to replacement cost, we tend to add these companies to our portfolio. Currently, we don't have, apart from one large state PSU, we don't have any of the energy companies within our portfolio, suggesting that the valuations are not as cheap as we want them to be. But again, our sense is they are not expensive in terms of valuation. You might have some negative news flow again based on regulatory moves that the government does. If that happens and they correct even more, we will add these companies to our portfolio. But right now, it's again in those in-between levels for us to add or to sell these companies.
The big drag, Nilesh, over the last 4 or 5 sessions, or probably over the last 10 sessions, has been the infrastructure basket, wherein the mid-sized infra companies have just fallen like a pack of cards and continue to fall. IRB for a different reason, but some of the others have also come off quite rapidly. The belief was that with the interest rate cuts coming in, they would actually benefit. That somehow hasn't percolated into stock price performance. You think the ails continue for the foreseeable future?
Again, our sense on the entire pack was a big corporate governance concern in terms of the at least reporting standards and the way these companies are winning contracts. And we've steered clear of the entire pack actually. We were concerned in the rally post or the rally which started late December and early Jan that we were studying the quality of stocks that were going up, which included some of these names or the stocks within this entire pack. our sense is, again, there seems to be a repricing of risk, and stocks which shouldn't have gone up are sort of coming back, and quality stocks are again outperforming in the correction. And that is where, again, you will see these stocks underperforming medium term, long term, until the corporate governance within the entire space improves.
How are you de-risking your portfolio at this point, given that it's been a fairly volatile market?
Again, we primarily remain stock specific, and we sort of had decreased our cash levels in December 2011. Unfortunately, some of these stocks have run up, and again we've seen an increase in cash levels to about 10% of the portfolio. By and large, the only strategy that we have is to invest in quality names at reasonable valuations, and we've seen stocks within our portfolio outperform over a significant period of time. And that is the only strategy we have of de-risking the portfolio, unfortunately. So.
Consumption is the theme which is probably now starting to crack a bit. Do you get out of some of these high-valued consumption stories, never mind the fact that the growth might be there because the market is looking weak, or do you still stay invested?
No, we've had a view, at least for the last 3-4 months now. The entire space is fairly overvalued, or the valuation remains strange. Again, they remain fantastic businesses, but a significant amount of earnings over the next 3 or 4 years is already factored in the price. So in terms of valuations, some of them are actually crazy in terms of valuations. So we've exited some of the investments that we've had in the portfolio, and our view is that the entire space remains fairly expensive.